Silver just handed every investor a photograph. The question is whether you're reading it correctly. In a single Thursday session, the metal dropped 10% in 4 hours. Not a gradual decline, not a trend reversal. A violent single-session institutional liquidation event triggered by one number on one Federal Reserve document. My name is Marcus Caldwell, independent market analyst. I've been documenting every major silver move from primary sources: JP Morgan, HSBC, CME data, COMEX filings. And what I'm seeing in the architecture of this crash tells me something specific. Something the financial headlines are getting completely wrong. Here's the setup that made this crash possible. Silver opened 2025 at $28.92. It closed the year above $72. A 147% gain in 12 months. That move shattered a decade-long ceiling above $30 and left most institutional forecasts in the dust. Every silver long position on the books was sitting on massive unrealized profit. That profit is the fuel. The Fed dot plot was the match. Before I show you the crash architecture, if this kind of primary source analysis matters to you, subscribe right now and ring the notification bell. This channel exists to give you the institutional level framework that financial media compresses into headlines. Your subscription directly supports independent financial analysis. Now let's look at exactly what happened Thursday and why it matters more than the price suggests. Thursday morning, the Federal Reserve released its revised dot plot. One rate cut projected for the full year. 7 officials projected 0 cuts. The 10-year Treasury yield spiked to 4.25%. For silver, which had run 147%, largely on dovish Fed expectations and dollar weakness, that signal hit like a circuit breaker. When you are sitting on a 147% gain, and the Fed just confirmed rate cuts are not coming this year, you don't need to be told twice. You sell, not because you've lost faith in the structural story, but because you have a profit and a reason to take it. But here's what made this crash different from ordinary selling. 4 types of sellers arrived in the same market simultaneously. Leveraged accounts receiving margin calls, forced to sell regardless of their view. Silver producers forward selling, locking in prices against their production. Institutional short sellers adding new directional bets on top of the liquidation. And long-term holders realizing gains after a 147% move. Then, on top of those 4 simultaneous sellers, the CTA funds activated. Commodity trading advisors, systematic trend-following algorithms that all run variations of the same model. When silver broke below a key moving average, every CTA fund received the same sell signal and executed simultaneously. FX Leader's certified analyst described it precisely on March 20th. Algorithmic trading and CTA unwinds amplified the crash beyond what fundamental supply data would suggest. A dot plot revision produced the trigger. 4 seller types plus algorithmic amplification produced the 10% crash. Those are 2 completely different things. Now here's the photograph nobody is developing. While the paper price was collapsing, the structural data underneath silver had not changed by a single ounce. 2026 is projected to be silver's 6th consecutive year of structural supply deficit. The projected shortfall for this year alone is 67 million ounces. COMEX registered inventories have fallen over 70% since 2020. Global inventories are at multi-year lows. Mining output is not keeping pace with demand from the energy transition. Solar panel producers, EV assemblers, semiconductor fabricators, they don't sell during a paper price crash. They buy because their production lines need silver at $70, just as much as they needed it at $100. And at $70, it's $30 cheaper per ounce to lock in procurement. The liquidation event and the structural deficit are operating on completely different timescales. The paper sellers are measured in hours. The physical buyers are measured in years. JP Morgan's head of metals research, Greg Shearer, identified the geographic buyers who define the floor in a liquidation event. China and India will play a crucial role in determining where silver prices find support after recent pullbacks. India imported $9.2 billion of silver in 2025 at prices that were rising, not falling. That is price inelastic demand. It accelerates at lower prices. It doesn't disappear. Now, the historical context, because this liquidation has happened before, and what the record shows is the most important data point in this entire analysis. In 1975, silver crashed 54%, from $6.7 to $3.1, inside what turned out to be a 2,300% bull market that ended at $50 in 1980. Investors who held through that 54% crash collected the majority of the bull market's total gain. Investors who sold at $3.1 watched silver go from 3.1 to 50 and missed every dollar of the subsequent 17-fold move. In 2011, silver crashed 39% in 8 days, from $49.81 to $30, after 5 margin hikes in 9 days. That crash marked the beginning of a 9-year bear market that took silver to $11 in 2020. The difference between 1975 and 2011 is the structural question every silver investor must answer honestly right now. Is the current crash from $121 in January to $71 today, a 41% correction, more like 1975's correction inside a structural bull market, or more like 2011's crash that marked a genuine cycle top? The answer depends on one variable: whether the 6-year supply deficit, which did not exist in the 2011 record, provides the physical floor that prevents paper selling from pushing prices to the level where industrial demand genuinely collapses. In 2011, there was no structural deficit. In 2026, the deficit is 67 million ounces and growing. Now, the full honest counter-argument, because analysis without the other side is just marketing. If broad-risk asset sell-offs continue, if equities keep declining, if margin calls spread across asset classes, the liquidation that produced Thursday's crash can extend further before the physical floor asserts itself. The most extreme bear case in published institutional forecasts projects silver at $25 to $26. That scenario requires a complete collapse of the structural deficit thesis and a return to pre-bull market pricing. It is not the consensus view, but it is a documented projection that belongs in your risk framework. Citigroup maintains a bullish second half 2026 target of $110. HSBC projects a full-year trading range of $58 to $88. Investing.com's base case projects the current $70 to $80 range as exactly where silver should be, not as a crash, as a base case scenario. The bull case at $85 to $90 requires only the resumption of macro conditions that existed 3 weeks ago before the dot plot revision, not a new catalyst, the return of conditions that were present for 14 months. There is one additional structural force worth mapping. U.S. government interest payments already consume 1/5 of all federal revenue at 4.25% yields. Every year yields stay at this level, the government's interest expense grows by approximately $50 billion relative to the lower yield environment. That fiscal pressure makes a forced Fed pivot or yield curve control not a conspiracy theory, but a mathematically documented possibility on a 2 to 3 year timeline. When that pivot comes, investment demand returns to silver. At the exact moment, physical supply is most constrained. That is Citigroup's $110 thesis in one sentence. Here are the 3 data points I'm watching this week. First, whether silver can close above $81.14, the level FX leaders confirmed as the technical close that would signal the bottom is in. Second, the COMEX eligible to registered conversion rate, whether physical floor buyers are beginning to convert eligible silver at current prices, confirming the physical bid is active. Third, the May Federal Reserve meeting. The next confirmed catalyst that could either extend the liquidation or trigger the investment inflow return. The photograph is developed. A 147% gain, 1 dot plot revision, 4 simultaneous seller types, and algorithmic amplification produced a 10% single session crash. The structural deficit in the background is unchanged. The CTA amplification in the foreground is temporary. The historical album shows 1975 clearly. 6 consecutive years of deficit do not disappear, because the futures algorithm executes a sell signal. If this analysis gave you a clearer picture than the headlines did, like this video, and share it with one person who needs it right now. And drop one word in the comments. 1975 or 2011. Tell me which historical parallel you think applies. I read every single one.